have a special guest today, Taylor Nelson, who is the director of non-performing loan investments in PPR at PPR. He leads the firm's non-performing loan portfolio and acquisitions. He is responsible for surveillance, which means monitoring the performance and monitoring the servicers, how they do on the portfolio itself. He's also responsible for performance on joint venture partnerships. To date, as far as I know, PPR acquired over $700 million worth of non-performing loans since 2019.
Yep.
And one interesting fact, I just came back from the Penn State presentation for the Young Entrepreneur Club, and Taylor is a grad of Penn State. Right. So is my wife. So
good company.
Big shout out to alumni.
That's right.
So Taylor, I wanted to get started with just an overview of PPR, right? So I know in the past PPR was responsible or was sort of targeting second liens, RPLs, NPLs, anything that's on the market. That market dried up. So what are you guys investing in? And just give me a rundown on the PPR activities in the past couple of years.
Sure. So first off, thanks for having me on, Alex. Appreciate the opportunity. But yeah, so like you said, PPR started, long before I came. They started back in around 2007. The three founding partners, John, Dave, and Bob, like you said, they started out in the second lien space, NPL second lien space back in 2007. Obviously a very different, environment that we're in now. And they considered it more of, like a club. They're, raising money from family and friends, very small, bought a couple liens here. Worked out of a couple of them, hit a couple home runs, kind of things like that. And then it grew legs, right? So for the next 10 years, they started raising more and more capital. And then I joined the firm in 2017. We had about $50 million of equity under management at that point, pretty much all invested, like you said, in second liens. But it's about that same time where kind of two things happened. One, like you said, the second lien space dried up a little bit. In 2018, 2019, most of what we were buying was, originated, 2007, 2008, or even around, 2011, 12. So that paper somewhat dried up, and we were just raising a lot more capital than we could only deploy in second liens. So we kind of took that natural progression from second liens to first liens, dove in there. It's kind of how we got hooked up with you on the diligence side of things, all that kind of stuff. So gradually moved from second lien space to the first lien space. That was, like I said, 2017, 2018, 2019. And then we kept growing even, faster than we could, really grow the business on our own. So we kind of went to a allocation, capital allocation, joint venture strategy wise that we could leverage, other people's expertise. And that allowed us to grow exponentially that are a lot quicker than we would have been able to grow on our own. When we did the second liens and we first dipped our toes into the first lien space, we were doing everything ourselves, right? The sourcing, the bidding, the asset management, the collateral review, the servicer oversight, everything, right? And that just, we were raising so much capital, we couldn't scale that quickly. So we partnered with, other firms who are experts in those different areas, and allowed us to grow, like I said, from 50 million equity under management in 2017 to now we have about 450 million equity under management, close to $500 million. We're close to 1.2 billion AUM right now. Largely still in that resi whole loan NPL space, about 60, 65, 70% on any given day, depending on asset sales or big acquisitions. NPL resi 60, 65%. Then we have a commercial side of the house now as well as we grow, and just to a couple of things, diversification, test some tax benefits for us and pass it through our investors with the multifamily kind of side of the house. But our lead and our main focus now and for the foreseeable future will be that whole loan NPL space.
Where do you find product nowadays? I mean, the NPLs also dried up. Fannie and Freddie portfolio is relatively clean. They do what 3 to 4 sales a year of NPL and mixed bag. The bids on those assets, it's pretty high,
Yep.
and it's not clear how people make money. So where do you find products right now, and how do you bid and to sustain the portfolio?
Sure. So, we participate in those auctions that you're talking about, the government auctions. But then, just a step down from that would be, kind of the big institutional banks that have portfolios of their own that have NPL, or maybe they bought those, Fannie Freddie or government auctions in the past 2 years, and it's the tails, or you always have, securitization collapses or fund closeouts. People are always looking to sell, the tails of the funds when they have to, wind up stuff. So, there's always product out there. To your point, yes, prices are tight, have kind of been that way since the interest rates and stops, significantly increasing in 2022, 2023, and since they've leveled off, we have seen definitely some tight prices. But I kind of look at it a different way of, instead of saying, shoot, how are these guys making money at this price? So we just did an RPL sale, and I'm like, scratching my head of, how are they, buying this for that price and making money? I think of the other ways of what are they looking at that we're not, or if they're able to pay this, what strategies are they implementing? And sure, maybe they have a lower cost of capital, lower yield hurdle they're trying to hit, or they have different reasons of buying RPLs. Maybe they're looking for the refinance business or the servicing rights, things like that. So they probably have different strategies. But I always try to look at it that way instead of, these guys are crazy, right? Because they're smart people, the people buying loans right now, they're making money generally and stuff like that. So try to spin it that
How do you model, Taylor, how do you model this, right? So you're responsible for the PPR modeling on the economy and forecasting what's going to happen in the future, right? So obviously those guys that are buying at the premium are modeling something that, maybe you're not seeing, or maybe you have a different opinion. How do you personally model what's going to happen in 2025 and beyond?
Sure. So like to that point, it is a relatively short duration asset for us. Because we buy the NPL, try to get it reperforming, and then we sell it, after, maybe 6 to 12 months seasoning. So we're not, looking out tremendously, in the future. And, it's an asset-backed asset, and so when you're dealing with, 50 LTV, 60 LTV, a lot of stuff can go wrong, but you have that asset at the end, right? So, unless there's a housing correction of, 30%, it's a relatively safe asset. You might not make a home run if you expected to sell your RPL at 103 and it goes to 99, right? And you're going to not make as much as you thought. But in the past, 4 or 5 years, you've had that safety net of so much home equity in these loans. And it's much easier to work with borrowers when they have, 40% equity in a house. So they have a lot more options. So that's kind of the short term. To answer, kind of the original question, I take a lot of advice and liens from, we have a portfolio management in-house, world-class economic forecaster. Spencer Staples, in his previous life, was a economic forecaster. He's came to the firm in 2017 as a consultant, has never left, and has really guided our forward-looking economic thinking that drives our strategy.
Well, it brings me to the next question,
Sure.
which is, an obvious one. A lot of folks that will listen to this podcast probably don't know or don't realize what are we talking about? How to make money in the second lien space, right? What are the second liens? So let me define it, and then maybe you can put some color on how they make money in the second lien space. So second liens are closed-end seconds, HELOCs, or home equity investments, right? So the home equity investment is a relatively new product. I've seen some of the HELOC vendors or originators sending homeowners credit cards, so you can really use your home as the cash machine with the credit card in it. So you can pay for things using the HELOC money, and certainly it's the loan that is always recorded in the second position, or supposed to be recorded in the second position to the first lien, which is your main principal loan on the property. And the job of the principal loan is to pay the taxes, make sure that insurance up to date, make sure that there's no sort of tax sales, everything is paid by the borrower, and the second lien is sort of sitting there and relying on the first lien originator or holder to do all the stuff to make sure that they don't lose their equity in the property. So that's sort of a mini definition of this market space. Used to be huge, right? When 2007 GFC happened, a lot of the HELOCs and second liens were on the market. Companies like PPR and others grabbed a bunch in millions.
Yep.
Some of them were wiped off with the GFC foreclosure. Some of them were not. But with the booming economy and zero interest rates, you didn't need it, right? So you just refi at zero, and then you're all set, because typically HELOC products are the higher interest rate. So coming back to you, how do you make money in this environment, right? So that's the folks that are listening are investors. Sure. They're buying properties. They want to feel it. Yep. Now, some of them are first lien investors, right? They're originators, they're banks, they're massage traders. So how do you make money with the HELOC?
Sure. Well, kind of back to what we were saying, second liens now operate a lot more like a first lien because of the equity. If you have, a combined loan to value of 70%, well, then that second lien is pretty similar to a first lien, right? That's very different to when we were buying loans, back in 2017. That was left over from the great financial crisis when, we were buying loans that the first mortgage, just easy numbers, $100,000 owed to the first mortgage, and you have a $90,000 house, right? So you're upside down on the first, and there's a $20,000 second. We were buying that $20,000 second for pretty pennies on the dollar, because you're already upside down on the first. Logically, why would someone do that? And then you realize that, sure, the numbers don't necessarily work out, but just because someone's 110, 115 LTV, it doesn't mean they are just going to pack up and move in the house, right? They have families, they have schools, they have jobs, right? So it's like there's an actual person there that isn't just going to look at the numbers and say, I'm not ever going to pay the second mortgage again, right? So if you buy, and that's a strategy where you buy a bunch in bulk, right? If you buy that one $20,000 mortgage, they might not pay the first mortgage, and the first mortgage foreclosed, and you're completely wiped, right? So you could lose, all of your money that way. But we were buying in bulk, right? So we were able to put large statistics on it like that, and we had a decent track of knowing the percentages of these that are going to work out. You don't know exactly which one's going to work out, but you didn't need to hit on every single one because of price point, right? If you were able to work out of 60% of the loans that you bought, you made your return, right? And then you kind of sell the remainder of the portfolio off as NPLs and make some money back, or the first lien forecloses and your mortgage is basically wiped. So that was the game, kind of back then. It was a large bulk play. We're buying these things at steep discounts, and you work out of, X amount of the loans. Now, today, like you said, there's, not a whole lot of product out there in the second lien space. And what is there? A lot of them have equity, right? So you're basically just dealing with the first lien, right? So that's kind of what we see on the NPL side. We had a large kind of book of reperforming second liens that we were able to buy in 2017, 2018, 2019 and convert them to RPLs. And what we saw in 2020 through 2023, like normally, like I said, you look to sell those RPLs to the marketplace, but the price that you would get, wasn't worth it, because we were seeing so many paid in fulls. Just every month there was, 10, 20, 30, 40 just paid in fulls, because to your point, you're paying a 7, 8, 9% second mortgage interest rate with equity in your house. just go get it. Just go combine the mortgages. Maybe you can get a cash out refinance or just lower your overall whack. And that's what we were seeing a lot of. That kind of went away a little bit when the interest rates started to rapidly increase in 2022. We liquidated a large portion of our reperforming second lien book early 2024, late 2023. But yeah, so when it's not really, is it first position or second position? Is where are you in the equity stack? And that's more how we view it.
Understood. Now let's touch on the one comment I did want to ask you. What are the typical returns on the fund that is involved in seconds? So in other words, if somebody who is an investor listening to our podcast, they want to invest because the returns are more attractive than the CDs in the bank.
Sure.
They'll probably contact you after the podcast is published. Yep. But what are the typical returns for the seconds?
So, it's hard to say because, like I said, if you're buying one loan, well, you could make, 300% on that, or you could lose everything, right? So it's, what are you targeting for that pool and what's your strategy? But we were seeing, 20 to 25% return. That's what we were targeting, on an unlevered basis, on our second lien acquisitions back in the day.
So if anybody is listening to our podcast and they hear the word 25%, sure, they're knocking the door probably next minute, because sure, I don't see those returns in the market right now. I mean,
no, certainly
look
not.
At the treasuries, you look at the CDs, you look at the structured notes. Yep. As an investor myself, even real estate property investment straight in will give you anywhere from 8 to 10%.
Sure.
25% is phenomenal.
Yeah, well, that was back in the days when there was plentiful amounts. Like you say, we were buying the millions and millions. And we were a pretty big player in that second lien space, and we were able to kind of go in and buy trades all or nothing and stuff like that, and kind of show a little bit of muscle in a very small niche part of the mortgage industry. Because now that we're on the other end of things, that we are dealing with large Wall Street banks, and we're on the other end of it where we're relatively small investors. But back then we were kind of the big players in the second lien space, and we're able to buy some trades all or nothing and get good returns on them for sure. And that was all, like I said, on levered basis. We were buying all those things with equity.
Yeah, those are phenomenal returns. Now let's switch to another product that you recently got involved in, and I think that's a new product for a lot of the investors. Let me first define it. I'm talking about a home equity line of credit, or HECM, sorry, home equity conversion mortgages, right? So HECMs are reverse mortgages that are typically taken out by seniors over 65 years old. You have to qualify for it. The lender sends the paycheck or sends the monthly amount of money instead of the borrower's paying. The lender is paying the borrower, and then the lender is getting the house, or heirs will buy the loan out, right, with the property out. So either way, you'll benefit, but it's a very, very long-term investment. So you've been focusing on that market for the past couple of years. Right. And if one would monitor where PPR plays, certainly a few public announcements are implying that you guys are pretty heavy into HECMs. Yep. So how do you make money in HECMs? Sure. What do you look for? How do you model it? Yeah. And where people will go to sort of invest in your fund specifically for HECMs? Sure.
So again, it's we deal in the HECM space at a whole is pretty large, right? I couldn't even quote the number, but we deal with a pretty specific niche where we're dealing with the HECMs that the borrowers are already deceased and there's no more, mortgage insurance left, right? So the assets are put back to HUD, who insured them, and now they're on HUD's balance sheet and they're looking to liquidate them, right? So we acquire the majority of our HECMs, through the HUD auctions. So you're dealing with and HUD will, rep and warrant that the borrower and any even non-borrowing spouse or deceased in their certified vacant houses. So we're buying the loan on these certified vacant houses, and basically a couple options, but one, you're prosecuting a foreclosure, and then you get to the vacant house, right? And then we're able to sell that into the fix and flipper market, or we're able to fix it up ourselves and sell it. So from a modeling perspective, it's a lot easier because you're eliminating a lot of variables, right? So when I buy or we're modeling first liens, right, you could get a loan mod, they could reinstate, and you sell an RPL. You could foreclose and sell at the trustee sale. You could foreclose and sell REO. Whereas here, you pretty much know your standard option is you're going to foreclose on the house and sell the hard real estate, the REO. Besides that, you can try to track down heirs and get them sign a deed in lieu and give them money to kind of expedite that process. But you're really doing the same thing. You're trying to get to that hard asset so you can sell that. So we liked it from the perspective that it's a little bit easier to model, but on the counterpoint to that is you have more risk, right? Because you have less options to exit. It's really a property value play. You need very heavy boots on the ground looking at the property. You need HUD provides interior inspection reports on all these loans, so we actually know. That's a huge variable when you're dealing in standard NPLs. Is sure you can have a real estate broker go drive by the house and give you opinion of value, but you have no idea what the condition of that interior is. So again, this HUD option eliminates another variable, as we know the interior condition. So as long as your diligence and your property valuations are correct, and you have the infrastructure to be able to prosecute a foreclosure and do all the diligence and the collateral view and things like that, stuff that your firm does for us, then it's really you acquire these loans, you foreclose, and you have that asset to do it. So it's with the environment that we're in now, that there's not a whole lot of product out there or houses for sale. This is a great way to kind of create your own product and inventory that way.
All right. So, Taylor, I have a message for Elon Musk.
Yeah.
Sell all HUD loans.
Yep. They're just sitting there.
There's a market for it.
Yep.
You're holding it on HUD books. HUD is losing money on every loan by doing the property preservation, the appraisal every month, compliance,
taxes,
you pay servicers. You're losing billions of dollars on the portfolio that are about to be sold. If you sell it on the secondary market to guys like Tyler, then you are lowering the price of the homes. And that's another purpose that presidency is trying to achieve, is driving the prices down by having more product for sale at the reasonable discounts. And then if you have the discount at the sale time, then certainly, marketplace will dictate what the right value is. Right. And to move the product, you have to lower the price. So Elon Musk, if you're listening, sell all HUD loans.
No, it's we're sitting here scratching our head. If you're thinking of from like a P&L perspective, like you said, they have thousands and thousands of loans that they're paying taxes and insurance on, and sure, that goes into the payoff and generally recoverable, but he's already upside down. So it's not recoverable. When I'm pricing this loan, I'm not pricing on the balance of the mortgage, because the balance of the mortgage is $500,000, but the house is worth $300,000. So I'm pricing on the $300,000. You're never going to collect what you're putting into it. So your point there, you're just throwing away the money. Yeah.
And Elon Musk, if you're listening still, Ginnie Mae portfolio is in the same boat.
Exactly.
Right? So if you're going delinquents, if you short circuit the Ginnie Mae portfolio to the Ginnie Mae sales, FHFA sales, you're increasing velocity of the money into real estate market. And a lot of folks will be employed on the capital market side, on the property preservation side, on the real estate sale, the agents, the prices will drop a little bit. So now all of a sudden we have the momentum that will kickstart the real estate economy. So certainly there's something there when you're looking at the HECM's market or Ginnie Mae delinquent portfolio. If there's a way to sort of short circuit going from delinquency 90 days plus to the sale, I think that will certainly do a lot of good.
It should. It really should.
But let's unfortunately Elon Musk doesn't hear us most likely. But let's touch on what do you expect for 2025, right?
Sure.
So very uncertain year, new president, a lot of regulations are changing. I think Chris Whalen told me when he interviewed Stan Middleman, from Freedom, what do you wish from the presidency? And his answer was interesting. He wishes that nothing would change, not just for 4 years, but for longer. Unfortunately, that's not the reality. And every 4 years, we have to adjust to a change from the business community or from where we get product in your world or how we design the diligence products in my world. So 2025 started off, in my businesses, we hit the records, right? It's all record highs. The money got a little bit looser. Some of the M&A activity started, which as you saw, the Keller Williams was bought by a fund, and then Rocket acquired Redfin. Let's see, there were a few other major M&A activities, mergers and acquisitions, and that forces me to believe that things are getting better. But what is your perspective in your world and your business?
Sure. So a couple of different things come to mind. I think I would agree with whoever you said that I would love things to kind of stay the same, because when interest rates finally leveled off in 2023, we've kind of been stagnant since then, and we kind of got used to this world and the pricing adjustments and stuff like that. So I think that's kind of our base case is, sure, interest rates might go down a little bit, or you might have some noise with inflation and tariffs and stuff like that. But generally, we are keeping the kind of same strategy that we have for the past year or so, which is, we are still looking to, I don't know if aggressive is the right word, but definitely acquire significant amounts of loans. We see great execution on the RPL sales, right, which kind of allows us to keep bidding those high prices on the NPLs. We see great financing rates, right? There's a lot of liquidity out there, a lot of people looking to put money to work. So it's good on that side of the things. But at the same time, like I said, we have a whole side of the house that is looking at those things on a daily basis and stuff like that. So we really take cues from them on a daily or weekly basis, and kind of gonna take it as it rolls, right? It's really all you can do. Like, sure, you can, everyone's got their opinion on what might happen, but no one knows, right? So I think the key for us is stay dynamic, right, and don't have a consistent strategy, but let the strategy kind of dictate itself. And we're always kind of, or at least I'm of the school that the marketplace is relatively efficient, right? So as prices should or go up or down, they normally do. Now, sure, you can have leans one way or the other and try to get out in front of some things or pull back when you see some stuff happening. But generally, we're not trying to time any market or anything like that. We kind of have our strategy, and we've been investing in non-performing residential debt for 17 years now through all sorts of economic cycles, right? When they started, it was the great financial crisis, and then you had 2012 and 2011, and then you had COVID, and then the rising interest rates, and where we are now. So we've kind of seen it all at some point, and we've invested and done well throughout those 17 years. And no matter what happens, I think there'll be a strategy that we implement in residential whole loan debt. What that is,
you see. do you see more product on the street, or do you expect more product on the street, or it's sort of steady as we go?
I think kind of to what we were talking about earlier, a lot of the GSC is going to agencies are going to drive that, right? So Freddie and Fannie and hopefully HUD should have some spring auctions here. They've basically been in a routine of doing one in the spring and one in the fall. I would love for HUD to kind of open up the coffers, like you said, and why are we doing a 2,000 loan sale when you have 20,000 that are eligible for sale, right? So
I did 75,000.
75,000, sure, right, yeah, exactly. So why are we doing it at 2,000 at a time? I would love, because more product, it would be, probably lower prices and things like that. I don't know about that because there is so much liquidity that they might just get bought up at the same yields they are now. But no, I mean, there's not significant amounts of product out there that we're passing on just because there's so much out there. If you ask me what I'd hope for, that'd be a great. But that also, it probably comes from some economic turmoil, right? How do you create more NPL product? Well, unemployment goes up and things like that. So it's not something that we wish for in that scenario. But if we do see some economic turmoil, it would be great for our acquisitions, right?
Yeah, it's the R word. We're going to get to recession.
Sure.
Yes. So it's a separate discussion, but it looks like the current president is really implying that we should go through some sort of a tough time this year to be on the road to recovery in 2026.
Right.
I actually agree with that because I do see credit card delinquencies going up and people are tapping into home equity line of products. They are still in that COVID mode where, you live only once and then you spend everything you have type of thing.
Right.
I've seen it, and people stop working very hard, right?
Yeah.
So the values changed a bit. So all of that translates to lower productivity and to be more efficient, you have to probably deploy AI and displace some of the jobs, and therefore it'll create NPLs sometime down the line. It'll take a long time, right?
Yeah, it always does. Yep.
So if I am the investor sitting and watching the podcast, and these two guys are talking, and they just want to know, how do I make money, right? Mm-hmm. Where do I go? How do I begin in 2025 and beyond?
Sure.
Either somebody is earning quite a bit and they're not happy with the current returns.
Yeah.
Their financial advisor is giving them some products that are not performing well.
Yeah.
I have a financial advisor that, one year it's phenomenal. Second year, the bonds crashed 30% and I'm sitting there and, what did you do? Right. How come you didn't know about it? So it makes me invest by myself as well, in parallel to advice of the financial advisor. So if they come knocking at your door, sure, how would you position them in your portfolios?
Sure. So I guess there's a couple of ways I could answer that. One is, how, active or passive do you want to be, and what's your size of capital, right? So if you can answer those two questions, if you want to be passive and you don't have, millions and millions of dollars to deploy, well, then you look to get into, one of our funds or, a different type of note fund out there. Right now, our flagship fund, Reliant Income Fund, pays a 12% preferred return, current or compounding, right? So if you want to stay passive, then you have a $50,000, $100,000. I would suggest you get into a note fund. If you are on the other end of that, and maybe you are looking to do something more, and you have a couple $1 million, well then sure, you could go out and start buying these mortgages like we do ourselves. There is again, it depends.
I don't recommend it, by the way.
Sure.
Because if you don't know what you're doing, then you'll
that's what I was exactly going to say. There's somewhat of a high barrier of entry, and there's a lot that goes into it, right? That hey, we were a $50 million firm with 35 people working there with 10 years experience in the note industry, and we didn't think we had the expertise to be able to scale to $1 billion company without partnerships and things like that. So an individual, certainly not, but there are strategies. I mean, back when first got started in probably 2010, 2011, we were teaching people the note business to do it just like we did, or just like Dave, Bob, and John did. So there is that niche market out there, and you can certainly still find one or two loans here or there from some trade desks and stuff like that. And like you said, I wouldn't have suggested if you're just picking it up and want to do that, then but if you really want to go all in and stuff like that, then I'm happy to share any questions or expertise that I can. But it's definitely there's definitely a learning curve for sure.
We just need to ask one question. The assets that are up for sale for a reason.
Sure.
And there's probably something's wrong with it.
You pick through
and if
those,
you can't see that something is wrong,
right,
then you don't know what to look at.
Exactly.
Right. So there's always this question. You have those assets that somebody's selling. There's a reason for it, right? They're not a part of the portfolio. Otherwise, they would be securitized in Fannie Freddie pools or Ginnie pool and not sold in the secondary market.
Right.
So you always have to be super careful, and you have to know which asset you can make money with, or which asset you really have to stay away from.
Sure. The only kind of niche space where I do see it work out sometimes is people who are very local and kind of fix and flippers and are looking for access to product. And one area where they probably don't think to look at is trying to buy the note and then foreclose. And now you have this, if you can buy a note on a vacant property, like we're saying, or people like us who, might not have the specific location knowledge. It might make sense for us to flip this note to, this guy for 80 cents on the dollar who can, foreclose himself. And now he's got this product, and maybe he's a realtor too. He's making commission on it, all that kind of stuff. So there is probably a niche space for the one-off investor. But like you said, I mean, you got to make sure you're not getting in over your skis and know what you're dealing with.
Yep, agreed. Any final words, Tyler, on where people should go to find you? Email, contact information.
Sure. So me specifically, anybody reach out, be tnelson at pprcapitalmgmt.com. But just for general, PPR information and information on our funds, we have 3 active funds right now. Google PPR Capital Management or pprcapitalmanagement.com, or on LinkedIn, Twitter, Instagram. If you type in PPR Capital Management and you can't find us, there's a problem. So, like I said, if personally reach out to me or give the email or phone on the website a call, and you'll get someone and they will be able to answer all your questions for sure.
Perfect. Sounds good. Thanks for your time, and great content for everybody.
Awesome. Thank you, Alex.
Thanks again.
For having me on.
Thank you.